Well, talking about matters markets, there seems to be a lackluster performance of the capital markets in the country at this particular moment in time, especially the stock exchange. Today, we try to pick the mind of an expert in this particular area to find out what exactly is going on and what can be done to ride the tide. Kathy, it's nice to have you on the show, Manan Markets. You're most welcome once again.
Thank you.
Now, the equity markets in Uganda, where are we? How are we faring at the moment?
Let's see, we have had a bag of mixed results for starters. We have had the highs and the lows. The lows are more eminent, of course, because the last time we had a positive increment on our turnover, on our capitalization, was 5 years ago. So we have had the market fall every single year. Year to date, last year we shared about 50% from a 35% the previous year. We are recovering this particular year because the year to date we are only above by 3%. So the 3% is too small compared to the 50%. So you move one step forward and then maybe about 10 steps backwards. But again, the other positive thing is that we have seen the listed entities try to improve. If you look at Stanbic, they're at a record profit of in excess of 200 billion shillings net of their profit. If you look at Umeme, so whereas the companies are performing better, the stock market is not reflecting that.
An appendage to that, there's a bit of a depressed performance at the Uganda Securities Exchange. What are the push factors for this state of affairs?
For the qualitative bit, the global equities market has shrunk. So let us look at the bigger bank, the Deutsche Bank from Germany. It is closing their equities line of business by 2022. And if you look at the size of the staff that are impacted, or that will be impacted for that period of time, it's about 78,000 people. So they're already exiting in Asia, they are leaving the UK. That is the impact in a bigger bank that has been here for a while. So for us here now who have spillovers from those markets, if there are jitters that other side, they will still come into our market. Yeah? And locally, we have also seen that some of our colleagues, our intermediaries, have also left the market. Because one, it's a market that has not returned. You can't even pay your bills with the commission that you gain on the exchange. And then what other service can you provide? Those that are staying, that is the question that they have. What else can you create for the value of the investors that have committed their funds or would like to commit their funds with you? But again, if you're only going to look at the equity side, it is a market that has also shrunk. If it's a lake, it's one that is almost drying up. So we need to either drill the water from the ground, or perhaps we need to find another avenue on which to help investors appreciate long-term investment.
Now, we seem to be getting hit even before we get started, because if you look at the performance and the participation specifically of Ugandans in the equity markets, still small. Could it be because you've not encouraged enough Ugandans, enough critical mass of Ugandans to participate in this as an investment option? And what are we doing to actually doing that?
Yeah, true. There is strength in the numbers, and the more we have our market domesticated, the better, because then the domestic market will understand the uniqueness that we have. Yeah. So let us see how many Ugandans, for example, know that we have a stock exchange. How many Ugandans know that I can actually own shares of Stanbic Bank, I can own shares in Umeme. So what we have as a challenge, one as intermediaries, is to make sure that as many people as possible understand that this is a platform for them as individuals or even as groups. What we're also trying to see that if individuals are more risk averse, at least have them in groups. We are seeing investment clubs coming. So for the risk averse individuals, then we can have the groups coming to invest, because then a group may not be as risk averse as the individual. But also for the investors that are in the market, what is the story that they're telling? What is their experience? Because you realize that investment, a person will go into farming because they had a story about someone who earned from farming. They will stay into farming because they have shared an experience of a person who probably had some losses, but they are better now. So we also need that traction to come from the people who have invested. Yeah. So the better appreciation of the market, what we're also trying to see is that how much more can a person use the assets that they have? If I go to the bank, can I use my shares? If I go to a circle and I told them that my collateral are shares that I have in a listed company, will they take that? Because if people can identify their shares to be much more than what a dividend can bring or capital gains can bring, then that will also be able to bring traction into the market. Because people buy land not because they're going to sell it tomorrow, but they know that if they had a need, they can use it as collateral security. There has to be much more that the equities, that equities as a property can give. And our role is to make sure that everyone has an appreciation of the equities market for the longer term, most importantly. Because for the short term, we have the jitters. They will always come. They have been there before, even before markets have rallied up. They have been there when markets are rallying down. So right now we are at a recession bit, but the markets recover. And we saw, if you look at 2007, 2008, 2009, it was recessionary on the equities market. It is not different from 2018, 2017, and 2019. But perhaps 2020 will be a lot better. Yeah. So as we go up, those who are in the market, of course, sell to the new ones who are coming in. So a person who will average out over the longer period of time stands to make maybe the most money.
Let's look at the impact of government securities on equities. You know, of late, government has been fairly generous on the kind of the interest rates it's paying on its securities. How has this affected you as players in the equity markets?
There is no doubt about that, because one is guaranteeing a return, the other is not guaranteeing a return. So we have seen traction in fixed income. The investors are committing their funds where they can be able to mitigate the risk as well as guaranteeing a return. What the equities has not done, the fixed income has done, even if it is on a smaller scale. So yes, the more yields we have, the better yields we have on government securities, then we shall see movement from the equities into the government securities. But also, if we are moving towards the election cycle, you see that people want to commit their funds in more secure instruments, because you do not know what the political environment is going to be like. Also, on the other side, we have seen that the government has been paying about 11%. 11%, if you look at the general investment environment in Uganda, is a fair enough return. Sometimes you don't return anything. So people are more confident with the 11% than maybe 22 that they would have gotten in the equities, because that has not been in the market previously. So yes, as the government increases its yields, we see the movement right from equities into government securities.
There are those who are advocating for forced listing. And, you know, the argument is that especially the big multinationals are mobilizing a lot of resources from the domestic market and repatriating it out of the country. What are your views on this kind of assertion?
Naturally, I don't think that force is the best way to handle economic things on a personal basis, because I believe that there should be an appreciation for a company to list. We saw what Tanzania tried to do, and the company can come and they put their share value way high. In the end, the investor who is going to invest their money, will they get value for their investment? Yes, the company has listed, and then even the size of the float. One of the reasons why our market is suffering right now is that we don't have enough float for the investors, even the institutional investors, to come and take part. So the more you force, they will just bring the little, and then they'll not be incentivized to avail the enough float. So ultimately, the longer-term effect of that may not be positive. However, the spirit behind it is something that we appreciate, because we know that the more we have listed companies, one, the more opportunity we shall have for our own funds and even investors to commit their funds in such institutions, because we support these businesses every day. I mean, we buy products from these businesses, so it is only prudent that they also give us an opportunity to own them. So force may not be the best solution, but the heart behind it, I guess, to get these companies in the market is a good idea. So yes, they should come, but it shouldn't be a forceful thing. They need to understand that it's a market that they can raise funds, and then they also have an opportunity to have us being part of them.
Of late, we had CIPLA doing an IPO, and it's been contending with a couple of, you know, headwinds, so to speak. What are your views on that particular stock?
Let's say CIPLA came in a time when there wasn't as much excitement in the market. But again, the investors did show up, because it was a successful IPO, and we have the company listed. For the person who is long-term, and if you are at the AGM of the company, you realize that before they were only looking at government, they were looking at global fund, they were looking at for other African governments. But right now they are even looking at going into the private sector. Had they not come, maybe say, to the stock exchange, they wouldn't have thought about that. maybe they would, but maybe at a later stage. But now you see that even a company is diversifying. There is more accountability. Yes, the market has not responded well to that particular counter for quite a number of reasons. They never gave a dividend. A shareholder wants to get a dividend in their first year. Yeah? But again, the company was also able to explain that. So I would think that the first 12 months is too soon a time for us to judge them. Since it's long term, let us see what happens. They're about to end their financial year, rather their half year, which is this particular month. So they have until December to give us their half year results. That should be an indication, because now we have new information. We shall have had the full year results, and then we also have the half year results to see where the direction of the company is going.
Mm-hmm.
Yes.
Thank you very much, Kathy.
You're welcome.
Always a pleasure to